All right, hello, everyone. Happy Monday. Welcome to this weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith. Derrick is the head trader at T3 Trading Group and the leader of T3 Live's ProDesk virtual trading floor. And it is a happy Monday indeed for the market, Derrick. Quickly, let's take a look at Derrick's positions. As I said, he is the lead trader, prop trader at T3 Trading Group. So here's what he's currently in as of our discussion here today. The topic or the title of our stream today, Derrick, is Trade Deal Rally. And we are getting quite a rally off of the tariff pause agreement between China and the US. Talk about how you came into this morning and how you've navigated this rally so far today.
Sure. So I came in net short, and I've been net short for, I don't know, a little bit over a week now, probably, which last week turned out to be like a consolidation week, despite a huge underlying bid from the systematics. So that ended up fine. Definitely dealing with a little bit of pain this morning, especially pre-market and off the open. I was down a lot, but I've been able to manage it well and reduce the amount that I was down from this morning. So it's about the best I can ask for at this point, to be honest, because this market is incredibly strong. I mean, the news over the weekend was exceeding the expectations, I think, of some of the most rosy analysts that are out there. I've been looking at some data, some analyst notes that have been coming from Goldman Sachs and JP Morgan last week. Goldman Sachs had estimated that the market was pricing in a reduction in tariffs on China to 40%, came in beneath that number. JP Morgan felt that any sort of a pause with China or any sort of a reduction in tariffs beneath 50% would bring the S&P up 3%. So we got that deal, and the S&P is up 2.75% right now as we're having this conversation. So pretty spot on from that JP Morgan note. And I mean, it's extremely bullish news. I mean, it's really been as simple as this. This narrative has been the same for months. When tariffs get reduced, the market goes up. When tariffs get increased, the market goes down. And that's just because tariffs are low growth and high inflation policies. So seeing a huge reduction in the tariffs with China, 90-day pause, giving way to expectations that eventually we can come up with a decent deal is about as bullish as it gets, because it really helps to reduce the worst case scenario risk of stagflation. So you can assume that the economy will be able to run a little bit better, and you can assume that the inflation implications of those tariffs get reduced, and that's just phenomenal. So it makes a lot of sense that the market is up as much as it is. With that said, I can't help but wonder at this point if we have just about priced into the market all the good news that could happen. I don't really know what else is out there that could be really good news for this market in the short run that could further propel us. Obviously, we can and will get more trade deals done, but the UK deal last week kind of gave us a base of what that's going to look like. So we kind of know that in a best case scenario deal structure, which I think that the deal with the UK last week was that you're not really going to be able to reduce tariffs beneath 10%. So there still will be an increase in tariffs from where we were in, let's say, 2024. But the worst case scenario left tail outcomes are gone. But again, as we now have retraced dramatically higher in this market, you wonder, are we running out of good news that could potentially come in? We are significantly above the Liberation Day starting point at this time, which also makes sense. I mean, if anyone remembers Liberation Day, Tariff Liberation Day, which was April 2nd, right when the market closed, we saw like a Wall Street Journal article or something that turned out to be incorrect that said that the extent of the reciprocal tariffs was going to be 10% on every country. And the market immediately started ripping on that. And then we saw Donald come out with his poster board with all those crazy numbers on it that then absolutely crushed the market. But what this is turning into now is actually almost a baseline of what the market wanted to see on reciprocal tariff day, on Liberation Day to begin with, which is basically just 10% tariffs across the board. because the market had been pricing in even something worse than that. So, things are looking significantly better. They're looking significantly more bullish. The technicals still look good, albeit they're extended to the upside. I just am wondering at this point if we are getting closer to a short-term top, because there will still be, I think, some economic damage that comes into our numbers over time as a result of this entire situation, though we probably don't see that until June. And I wonder, what other good news could there possibly be? Eventually we'll get other deals, but it's probably starting to get pricing in the market at this point.
Do you think this isn't a trade deal forever? This is a 90-day pause, like the other reciprocal tariffs were a 90-day pause to then continue negotiations. What happens in 90 days for the market if there's no long-term deal reached between the U.S. and China?
Sure.
It's worse than Liberation Day?
So we need to know a couple key dates: July 8th and I believe August 10th. So July 8th is that 90-day pause window for every country, I guess, except for China. And August 10th now will be the 90-day situation for this China deal. So again, this is all stuff that still is making me wear a little bit of a bearish hat right now, because I think that in what we've seen in the last several weeks has been this positioning squeeze to the upside, where we were still very early on in pausing tariffs, and there being all this headline risk on getting deals done to the upside for the market. But now, as time goes by here, we got to get these deals done. And what we also tend to see from Trump is when the market improves, he gets a little bit more emboldened to say things that might hurt the market to get his agenda passed. And we all hope and pray that agenda leads to the long-term success of the United States. So, now that the market's doing well, and as we get closer to those July and August dates, and we get closer to seeing some of these economic numbers hit that begin to show the impact of those tariffs, and as most of the headline risk seems to be out there, that all seems to me to be like declining towards bearishness for the market. I think it's still a little bit early, and that's really what I've been preaching for the last week or so. Even last week, as we went sideways, there's just been such a strong systematic bid to this market. One of my big themes in trading that I love to talk about is don't fight the flow. And I had a game plan in place that's been a game plan for weeks that dictated at certain price points with the market, I would begin to kind of get net short and continue to build into being further net short the more we go up. I'm even continuing to follow through on that and do that today. But seeing the data update in real time, it leads me to believe that I am too early. And obviously with the gap up this morning, it further confirms that I'm a little bit too early. But yeah, we'll see how that plays out. I do think that there's a lot of downside risk potentially to this market, but it's also still a little bit early. We got to get through probably at least this week before we can see more significant opportunity, I think, for downside in the market.
You talk about Trump and how when the market's doing better, he's more emboldened to be a little more bold. We saw the market get pretty spooked by him calling out the Fed chair, kind of threatening that he might fire the Fed chair, all of those things a few weeks ago. We had the Fed meeting last week, Fed saying, we're data dependent, we're going to wait, we got to see the impact of the tariffs, et cetera, et cetera. Definitely spooking the market with a little bit of a stagflation concern, but the tariff pause kind of helps that. If we get to June and no rate cut, Trump was still calling for Powell to cut rates even though they didn't. Do you think that Trump could be more critical of the Fed now that he's kind of removed the tariff excuse from them?
Potentially, we'll see. I mean, right now we're in the midst of the Trump pump. We really saw it at the end of last week. He was hyped when he got the UK deal done, and immediately after getting the UK deal done, he was like, the EU is next. We got tons of deals going on. China's about to go really well. I think he even said on Thursday of last week after the UK deal, like, it's a great time to buy stocks. And he's 2 for 2. He's 2 for 2 on saying it's a great time to buy stocks. The first time he said it was on the first time that we paused, when the market had like one of its biggest up days of all time because he paused on tariffs. And the second time he said, I think it's a good time to buy stocks. You know, within a couple of days, we got a pause with China that helped propel us higher as well. So, you know, I've always felt that his biggest interest is, I mean, we just saw it in his first term. He uses the stock market as a scorecard. And of course, when the stock market's not going well because of some of the policies he's implementing, he's saying, I don't care about the stock market. Don't worry about that. But we've seen it forever. You know, we've seen it even before he became president the first time. I think that there's still a tweet that I see get recirculated every once in a while that was like, if any president causes the market to go down over 1% in a day, that president should be impeached or something like that. I'm definitely not quoting it exactly correctly. So, he loves for the market to go up. And I've always felt that with him as president, there's a big right tail risk to this market on him doing anything and everything he can to make the market move higher. And even when you look at this deal with China, or this pause with China, the original tariff rate that China had on the United States, depending on which analyst you looked at and exactly how it was calculated, was really somewhere between like a little bit over 6% and a little bit over 9%. And now, excluding the additional fentanyl part of the tariffs, we're at 10%, or they're at 10% on our goods, regardless. So it's almost like we've done this entire big circle just to get back to really where we started. And I hope that it turns into more than that, because there's been a lot of headaches and damage along the way just to get us back to where we started. But yeah, I mean, we'll see how it plays out. He's such a wild card. I don't think that he anticipated that his tariff announcements were going to hit the market down as much as they did. I think that's just a little bit of a lack of understanding, honestly, of tariffs implications on the market. But we saw at a certain point, he blinked when he paused with the original tariff pause. He blinked again over this weekend. And it's really been all of us like starting something and then working on fixing it. And we'll see what it leads to, and we'll see if it leads to higher price action. But he's a huge wild card in both directions. Like, you can't count him out as we get closer to July and August to reinvigorate this tariff conversation and bring the markets lower. But you also can't count him out to do everything he can to get his scorecard to show him the best rating possible. And I think that especially becomes true as we get closer to midterms, because the fact of the matter is his popularity took a hit because of this entire situation. And he's going to want to see the stock market at all-time highs, and he's going to want to see his ratings at highs going into those midterms in order to maintain power. So we'll see. Your guess is as good as mine on what his next move is.
All right. Important economic data coming up this week for the market. It's not only about tariffs. We're going to get the CPI, retail sales, PPI all this week. And those are important numbers for the inflation picture, especially on the backdrop of the Fed meeting last week, the stagflation concerns happening. How do you feel headed into these? Which data point is the most important for you this week, or do you think none of these really matter anymore because you got the tariff announcement over the weekend?
So they're pretty backwards looking. So I don't think that really any of these numbers are going to prove to be dramatically important. The inflation numbers will probably be the most important of them. We don't want to see like a significant spike in inflation before we're even really beginning to see that the tariff numbers take hold. We should see, I think, like a little bit of an inkling of the beginning of an increase in inflation on these numbers that does result from the tariffs. But like I think I said to you last week, just as an example, the de minimis exemption on cheap goods that was coming from China was only really gotten rid of in practice at the very beginning of May. So you're not going to see those numbers hit the inflation report that's for April. You're going to see that in June when we get May's numbers. So I think that's going to be what's most important, and we're still a month away or so from being able to see those numbers. But there might be a little bit of an uptick in inflation, just almost like in anticipation that they're coming. But it won't be as dramatic, I don't think, as when we begin to really see the numbers of what these policies have done.
All right, I want to look. Can we pull up your charts and look at some of the levels that you're focused on in your personal trading?
Sure. Let's get them up. Entire screen number 3, click. Okay. Yeah, so you can just see, really big gap up in the market, and it's been grinding higher since you and I started talking. So now the S&P is up 2.9%. 580 is been a pretty important level throughout the intraday today. We gapped above 580. We immediately sold back below it. We retested it 1, 2, 3 times, failed every time. Now we're getting the 4th test of this 580 right now. Every time a resistance level gets tested, there's a higher probability of a break. So I'm not surprised at all to see on the 4th break of 580 that we're getting above it now. So the market, I mean, it looks great. We sold down a little bit in the beginning of the day. We're set to close on highs. I think that there might be, again, there's just a lot of people that are caught off sides in this market that is creating, I think, like a forced buy-in. Anybody who is more of a macro analyst in this market has been super bearish. Anyone that's taking a macro approach, and no one has been prepared. This is the maximum pain trade. Is really upside in this market. And even now this morning, I saw some data out of Goldman from Friday after the close that just indicates that people are really, really underpositioned to the upside. So this is like the worst case scenario for a lot of traders and investors who do this professionally, that this market actually keeps moving higher. At a certain point, that kind of creates a little bit of a forced buy-in. So we'll see what this squeezes up to. With that said, we have a very healthy degree of upside extension here. So the way that I like to measure extension on any stock, any market, on any time frame is where we're trading versus the space between the 8 and 21 EMA. The 8 EMA is my blue line. The red moving average here is my 21. So let me just repeat that in case I said that wrong. 8 EMA is blue, 21 EMA is red here. The space between the 8 and 21 EMA is what I consider to be technical equilibrium for the market. So the 8 EMA, which would represent the upper band of equilibrium, is trading just below 565. We're trading above 581. So we've got like $16 of upside extension off of just the 8 EMA while I'm having this conversation. That's a very, very healthy amount of upside extension. One of my rules in trading is I don't chase price. When we go up a lot in a short period of time, I'm not a buyer. When we go down a lot in a short period of time, I'm not a seller or a short seller. It doesn't necessarily mean that I'm going the other way. It doesn't necessarily mean because we're extended up a lot that I am shorting, or that we're extended down a lot I am buying, though there becomes a higher probability of that. Again, like the absolute low in this market was a huge day 3 gap down with the most extreme amount of extension I think I've ever seen in my entire career. That was something that I was buying with both hands and both feet. Here, we have a lot of upside extension that makes me want to come in the other way, and I did do some shorting pre-market this morning, but it's also only like a day 1 since that news, because we spent all of last week digesting the big up move that we had from the 2 weeks prior to that. So we're in a little bit of a tricky spot here where I definitely don't want to be chasing this move in this market, especially when I think that the headline risk is now actually becoming more to the downside. But you got to be a little bit cautious shorting a day 1 up at this point, especially when it looks like there is going to be a big systematic bid, potentially a big bid into the close as well, just from a continuation of a gamma squeeze that also to some degree is coming from these leveraged ETFs. So got to be a little bit cautious. I think if you could get at this point to 590, that would be like an all hands on deck short. You'd be getting back to levels in the beginning of March. You would be probably within 5% of all-time highs at that point. And this was a really important couple sessions here at the very end of February and the very beginning of March. You have this nasty negative Maribozu candle that came in. The high of that is 597. The low of that is about 580. So taking approximately the midpoint, it gives you that 590 area. If we could, if today does prove to be just a day one to the upside that leads to like a day two, day three type of squeeze, if we can get into 590, then I'm probably going to have to really, really be seriously shorting this market at that point. That's a spot that I'm paying attention to. So again, for me, even though we could get up there, no new buying here, building into some shorts, get into 590, then I'm probably going to go like gung-ho short at that point. And I also think that the more we can get through time, the more it can actually begin to facilitate the downward price action in this market. So it's the SPYs. Qs here are pretty much the same deal. 510 is really important. 520 is really important. We're at 506 right now. The only difference between the SPYs and the Qs are like $20 extended, whereas the SPYs are about 16. So we have an extreme amount of extension to the upside. IWM continues to be weak overall, but we saw some data that showed that the IWM had its largest short float, I think, going back to 2020. So this just goes back to people are off sides in this market. They're not positioned properly for this up move. So there's being forced buy-ins of not just short sellers, but also people who need to have that long exposure who are having to chase performance to the upside. So we could get a continuation of some degree of a squeeze here. As far as individual stocks go, I'm very much, market first focused, especially on these big days before I break it down into any individual names. One thing I did really well with this morning was Palantir short. So Palantir, like everything else, was having a really big gap up this morning. That gap was to the gap fill of the earnings report. So I liked it short into this like 121 to 123 area. I was shorting it pre-market. I had also noted to the team that the pre-market price action of Palantir was relatively weak compared to the Qs. Like if you could overlay this Palantir 5-minute chart pre-market with this QQQ chart pre-market, you could see that into the pullbacks on the Qs pre-market, Palantir was acting significantly weaker. So Palantir was actually my favorite short for today. And it worked out so well that it honestly saved my day because I was down a lot at one point pre-market when we first gapped up really big and was able to make back like 3/4 of what I was down. And Palantir really helped that significantly. And I had also noted NVIDIA, but NVIDIA actually just picked up some serious strength here over the course of the last hour and a half or so. NVIDIA has been relatively weak. It broke out above this 115, which was a huge level on the daily chart. But Thursday, Friday, after that breakout, it wasn't trading right. It was trading relatively weak compared to the other semiconductors. And then pre-market this morning, it was up less again than the other semis. NVIDIA was up like 4%, then AMD was up like 9 to 10%. Micron was up like 9 to 10%. So it was a similar deal where I noted the relative weakness on a percentage basis and also noted the relative weakness. If you could like overlay a chart of the Qs with NVIDIA pre-market, you would see that this was trading weaker at that time as well. And that put this on my short radar also. And it was pretty weak from the open compared to the market, though again, these last couple hours, it's picked up some strength. So that's kind of what I'm doing in this market is we're so extended up that if you want to try to short, there's kind of two schools of thought on how you can approach like market saying I want to short. So what stocks do I want to short? And I would say that there's like a couple two main categories that you would want to look at. One is the names that are relatively weak. So relative weakness, obviously, if the S&P is gapping up 3%, and you can identify a stock or a sector that's red, that's negative on the day, or that's up less than 3%, the amount that the market is, that's going to be a relatively weak stock. The problem with a relatively weak stock is that it's not as extended as the market is. So that's going to mean that your reward profile on that trade becomes a little bit less. But the benefit is that you're shorting something that's relatively weak. So you might get more bang for your buck. If the market moves down, the weakest stocks might move down the most. The other school of thought is I want to short the things that are most extended because the things that are most extended are going to give me the largest reward profile if that trade actually works. The problem with shorting the things that are most extended is that they're usually most extended because they were the most relatively strong. So it's like on the one hand, you can short what's relatively weak but have a little bit less of a reward profile, or you can short what's relatively strong and be shorting something that's relatively strong, which is not ideal. And I've been doing this for a long time, and I haven't necessarily seen a consistent outcome where you always want to short the relative weakness or you always want to short what's most extended. I feel like it a lot of times is pretty situationally dependent on what works out best. Like sometimes those weaker names end up actually holding in a little bit better as the extended stuff all sells down really hard. Sometimes it's the opposite. The stuff that's extended, you can't get a downtick from it because it's so relatively strong, but the stuff that was weaker, even if it's not extended, is getting hit the hardest. And again, I haven't really seen a consistent, like, this is the one that you should go after. So the approach that I tried to implement in the pre-market was like a little bit of a combination of both. Like I'm shorting things that are up a lot on a percentage basis, so it's giving them a lot of extension, but I'm trying to identify pre-market what's not trading as well. And the names that I was able to identify that weren't trading as well pre-market were basically Palantir and NVIDIA. So I was like, all right, if I'm gonna try to lay into some shorts because of how big this market gap up is this morning for some sort of an opening pullback, which really was the team's game plan for off the open, those are the names that I'll go after. And it worked out pretty well, especially with Palantir. So yeah, I hope that helps.
All right, good stuff, Derrick. All right, real quickly, you talked about how you came into today more net short than long, and you were definitely experiencing some pain with the gap up this morning. Talk about how you managed to not get flustered by being down in a morning like today and manage your positions properly versus kind of panicking when it comes to your portfolio.
Sure. So I do get flustered. I definitely get flustered. That would be the first thing that I would say. I'm only human. I experience emotions. I definitely get upset if I'm seeing that I'm down a lot of money or whatever. I think that's normal. The key to it is to not act on those feelings. The key to not acting on those feelings is to have good game plans in place. I really think that like the key to basically what you're asking me is a trading psychology question. And I think that the key to countering almost any bad trading psychology that a trader might encounter, and it can come from so many different places, is good game planning. Because your game plans are that's your anchor. It's your anchor to the market. That's your anchor to consistency. I think that the key to trading is really the following series of statements. And I repeat these statements a lot to the traders in the morning and afternoon meeting and everything, just because I think it's just so important to remind everybody that this is what you have to do in order to be successful in this business. So the goal of a trader is to be consistently profitable. You want to be a consistently profitable trader. The only way that you can be a consistently profitable trader is if you are consistent in regards to your actions to the market. The only way that you can be consistent in regards to your actions to the market is if you have rules that govern everything you do in every scenario that you find yourself in. Then you have to have the discipline to be able to follow those rules. Those rules manifest themselves in a trader's game plan for every trade that he takes or she takes. So that's what it comes down to is you have a game plan for every single trade that you're in. You know that those are based on your trading rules, and you have the confidence to believe that those rules will give you consistent profitability. So, when I'm down as much as I was down this morning, when I woke up and logged into my computer and saw that we're gapping up like 5% in the NASDAQ, and I'm short a levered NASDAQ ETF, am I upset by that? Absolutely. Am I flustered by that? Absolutely. Do I want to scream and curse and cry and bang the table and everything else? Heck, sometimes I do. But what I also do is everything that I physically possibly can to not deviate from the game plan no matter what. And to me, that is the key to it. You've got to believe in those game plans. They're the only way that you can be consistent with the market, and therefore the only way that you can be consistently profitable with your trading.
Good stuff. Good stuff. For you going into this weekend, we knew this China meeting stuff was happening. Why did you go into the weekend net short? Because, we expected something to happen. So there was the possibility of a big gap up on Monday. So what was your thesis headed into the weekend, the positions you were holding?
Sure. So if you go based on the research, like harkening back to the Goldman Sachs note that I mentioned, Goldman, off of a note that I read, was saying that they believe that the market was currently pricing in a reduction in tariffs from these negotiations to 40%. From the 145% or whatever. So we don't know, of course, on Friday what the outcome of those negotiations are going to be. There's no way to know that. But generally speaking, off of some really smart analyst data and information, the expectation would be if tariffs are reduced to 40%, that the market opens up flat. If tariffs are reduced to somewhere between 40 and let's say 80%. And keep in mind, Donald Trump, I think on Thursday of last week, Thursday or Friday morning, said, I think it'd be great if we brought tariffs down to 80%. So if tariffs were reduced over the weekend on China from somewhere between 40 and 80, the market was probably going to go down a lot. And if tariffs were reduced to somewhere between 0 and 40, then the market was probably going to go up a lot. So like most news events, it's a little bit of a coin toss based on not just what the outcome of the event is, but what the outcome of the event is versus expectations. So if expectations are, and Goldman Sachs is not always perfect, they're wrong a lot too, but I'm just using them as an example. If expectations are a reduction of 40%, that's your bogey, right? So you don't know what it's going to be, but above that, the market's going down, below that, the market's going up, and at zero, the market's potentially not going to move at all. So that's the real question kind of coming into it is where do you think that these things can land? And like I said to you in the beginning, I think that the reduction to, basically this 10% number plus the extra 20% for the fentanyl stuff was beyond the expectations, honestly, of even most of the bulls that I've been reading the research of. So this was like the ultimate best case scenario that led to a really big market move higher. So why am I going net short into that type of an event? Well, first of all, I don't know how the event's going to go. You could really have seen it go either way, in my opinion. But also, it harkens back to what I was just saying. I've had a game plan in place, Greta, since you and I were talking back on Monday, April 21st. I remember this day. The SPY has traded down to like 510 while we were talking. They're at 581 right now as we're talking. I was 100% net long. The game plan that I had was I think that there is room for a positioning squeeze to the upside. I was 100% correct in that statement, though as of this morning, it's starting to even overshoot my expectations. And I thought that my expectations were pretty darn bullish on a potential of a 570 target. Again, 510 to 570. That's a huge move. We're now actually at 581. And I had a game plan in place that said, as we move higher, which is my expectation, I'm going to consistently lock in profit on my longs. And at a certain point, I'm going to build in shorts to get more net neutral. And at a certain point, I'll even get net short if we just continue to go more or less vertically up. And that's pretty much it. I have a game plan in place. I'm following the game plan. And that's literally how I trade regardless of the outcomes. So now we are where we are, and I went from making a lot of money on longs into the initial up move to now starting to lose a little bit of money on some of the shorts I have, really starting with today's session in particular. Up until today, my shorts have been relatively fine. And it is what it is. I believe in my ability to be able to manage my positions per my game plan and generate day-to-day cash flow from my trading while I wait for this bigger picture to play out.
All right, great stuff, Derek. And a good comment from YouTube here from Brian said most traders would have been too ashamed or egocentric to talk about a losing day on a big gap up. And I got to give you props, Derek. You're never too big of an ego to admit when you are wrong or when something has not gone your way. And it's great.
Thank you.
Props to you for that, Derek.
Thanks,
all right,
Brian
I'm going to let you
Greta.
go, Derek. Derek is a real trader. Again, he's the lead trader of T3 Trading Group. So I want to let him get back to managing his positions in this market and the rest of the week. So if you want to get Derek's free ebook, you can go to t3live.com/DOLive. It's based on or covers the benefits of prop trading and how you can prop trade with Derek and T3 Trading Group. Again, that's t3live.com/DOLive. Derek, good luck with the rest of your week this week, and I'll see you next Monday.
Thanks, Greta. Have a great day.
You too.